You are watching Trading Day. I'm Amber Kanwar. As we mentioned, we've got our eyes on RioCan. The stock is trading up as earnings came in better than expected at the Real Estate Investment Trust. Now, with all the concerns about retail and physical presence of retail stores, RioCan churned out record high occupancy, forecasted better funds from operations than the market was looking for, and boosted their distribution by 3%. But when you look at the stock over the past year, it has been under pressure as interest rates rose. Joining me now for perspective into the business and the market environment, we've got Jonathan Gitlin, President and CEO of RioCan. Thanks so much for being with me.
Amber, thanks so much for having me. And I have to say, I don't know why I didn't wear a red or a pink tie today. I missed the opportunity.
Missed opportunity.
Just early morning. I hadn't had my coffee yet when I got changed.
Well, you had a lot to do today as well. Earnings out, speaking to investors, and I mentioned kind of that tension between the fundamentals seem to be going great, but the rub, of course, is the interest rate environment and also probably sentiment, right? I mean, how are you thinking about those two factors?
Well, I think you've nailed it when you say that there is this juxtaposition in themes. There's this great operating backdrop, which actually keeps on getting better, and I'll get to that in a second. And then you've got the interest rate backdrop, which hasn't really relented since inflation started hitting unfortunately, our population about 2 years ago. But the way we fight these interest rate headwinds that we've been seeing is by those great operating fundamentals. We've improved our portfolio dramatically. So over the last 5 years, we've shifted to being a major market REIT. Most of our retail is in very well-traveled thoroughfares with a lot of great demographics around it. That's exactly where tenants want to be. And you've got tenants that are in growth mode. I mean, retailers are doing exceptionally well, and they want to get into great environments, and that's what RioCan provides. So we're seeing a big uplift in the rents we can get.
I want to pick up on that. Retailers are doing extremely well because there's high-profile examples of an exodus, and perhaps those get covered a little bit more than new store openings. Is the bulk of the growth you're seeing in retail not just traffic, but is it the brands that you're with expanding even more? Or are there foreign entrants coming into Canada?
So there's a little of both. And remember, retail always evolves. So there's always going to be headlines around some that have evolved the wrong way and have left the marketplace. But the good news is that there's a lot of very strong Canadian incumbents right now. I mean, if you look at all of our grocery stores, they're typically all Canadian based, and they're all in expansion mode. There's
some of your tenants there, all household names.
Exactly. And they're all necessity-based retailers that actually do well in most economic backdrops, including recessionary or times of growth. And that's what we've really catered our portfolio and our tenant mix towards. So they're doing very well and they're in expansion mode. But then if you add to that, there's been a lot of great announcements about certain retailers that are international that are actually looking to expand into Canada. So between all of those and the severe lack of new retail space that's been built over the last decade, you've got a pretty good environment.
And yet, you did have to deal with some sudden vacancies. And I was surprised to see not only how quickly you were able to fill those spots, but at higher rent.
Yes, and I think that's the underlying theme that people haven't really appreciated as much as we're seeing. But it's a really good environment. So like I said before, Amber, you're always going to have churn in retailers. But we now have a long lineup of tenants that want to take the space. And a lot of that is because we've really classed our portfolio over the last little while, and the space we have is always surrounded by people. If you look at our demographic profile, like across our portfolio, there's an average of 260,000 people that live within a 5-kilometer radius of our properties, and their demographics in terms of household income, it's $140,000. This is exactly what tenants or retailers want to see. So it's really a good environment for us.
The population growth has been literally off the charts. Yeah. How do you experience that as a landlord?
So there's two elements to that. First of all, in retail, which is often overlooked, I think a lot of the population growth story has gone on to housing. But in retail, I mean, people, new entrants to this country, they want places to shop, they want places to meet. And so we're seeing a lot of that happen at our shopping centers. But the other thing I would say is that a lot of the retailers, whether they're international or Canadian, recognize the strength in all of this new population and their ability to spend at stores. So we're seeing a good push from that population. But then going back to the other element of RioCan, we've got RioCan Living, almost 3,000 residential units and growing.
Yeah.
And that has been a very good part of our business. And I think population growth certainly helps that.
RioCan Living is something that a lot of analysts talk about. You have this goal of getting to 50 to 60 million net operating income.
Yes.
And I got to remember my acronyms
NOI.
when it comes to NOI.
Live it and breathe it.
Do you foresee, like, once you get to that point, does it make sense within RioCan? Do you spin it out so investors can get separate exposure? Would somebody want to buy it? Like, what do you think about it? And completion is what, a few years away?
A couple of years away. Yeah. We're well on our way, and I think we forecast exactly how long it would take us, because most of the projects that make up that $50 to $60 million of NOI, they're already in the ground. We know when they'll be completed, or we've purchased a couple of these multi-res assets. But I think that, you've kind of hit the point exactly. We'll have all these options once we get there. We wanted to get to that level of scale, because at that point, we're almost like it is its own REIT in a way. It's big enough to IPO. It's big enough to keep for ourselves as long as our unit holders are giving us value for it. Or we could sell it, or we could expand it. So there's all of these options, and quite honestly, we've got a line on every one of those options, and when the time comes, we'll make a decision.
Interest rates, though, are kind of like a lead foot on the neck right now. This is supposed to be the year of rate cuts. The market has sort of repriced that around and pushed it out to later in the year. How do you think about interest rates, what you can manage around that? I note that you pulled back on construction intentions.
Yes.
So is that how you're managing it? What if we don't get a rate cut this year?
Yeah, and we're prepared for any outcome. We've always had a very well-pronounced debt ladder, which simply means that we never have an outsized number of financings coming due in any one given year. So we've got plans, we've got plenty of liquidity that we can use immediately to pay down any debt that is coming due. But the debt market is still there for us. The pricing might be a little higher than we're accustomed to, but we have a big balance sheet, and we can absorb a slightly higher interest cost. And particularly because operating fundamentals are so strong. We're showing growth this year, we predict growth next year, and that's in the face of a significant bump up in interest rates. So we'll do it the old-fashioned way, which is really just to have an amazing operational result.
In real estate, we saw, and I'm sure you paid attention to, Blackstone buying Tron. As an outsider watching that deal, what did that say to you? What was the signal? The
signal is that Canada's great. Canada is an excellent place to do business, to own real estate. And I think there's a lot of, even though Tricon does have real estate in the US too, but I think it is a Canadian company. And I think it shows when someone as intelligent as Blackstone and others view Canada with such incredible opportunistic, through such an incredibly opportunistic lens, I think it just lends to the whole notion that real estate in Canada is a good long-term theme. And I think it only gets better with our population growth.
Do you think we see more deals by private equity in this space?
I think you see more deals by either private equity or other players. I think there's a lot of companies out there now, and consolidation wouldn't be something that shocks me, or someone coming in and buying some of these companies.
Would you play a role in that?
What I am here simply to serve my unit holders, and if ever there is a transaction that serves them exceptionally well, then all I am here to do is facilitate those types of transactions.
All right, you're a lawyer.